For many people, purchasing a home is the single largest purchase they'll ever make. But it also takes a long time to save and plan, which is why looking as far ahead as possible is a good idea. Sure, things may not go as planned, but having a plan in place means you're at least moving in the right direction, regardless of outcome. So the question is, how will the housing market look in the next 5 years? Year 1. It should come as no surprise that the real estate market is expected to soften over the next year, following a period of record low interest rates. We've seen a significant increase in the average mortgage after 4 subsequent 3/4 percentage point hikes from the Fed to combat sky-high inflation. The current average interest rate on a 30-year fixed mortgage is 7.08%. That's the same average was less than 3% just a year ago. Crazy how it's been, but that's a significant difference, and for sure it'll have a significant impact on first-time home buyers as potential movers as well. Let's say, for instance, a $300,000 30-year mortgage at 2.98% will result in a monthly payment of $1,262. But at the current average rate of 7%, that same mortgage could cost an extra $750 a month, bringing the total to $2,000 a month. Geez, I mean, that's really a lot, considering that's an additional $750 a month at the time when budgets are already stretched and pay raises are so scarce. It's not going to be a surprise that U.S. home prices will fall 5 to 10% over the next year, so just keep that in mind. Year number 3, well, if you're expecting a rapid turnaround and it's gonna happen, unfortunately it isn't. So research projections are showing prices leveling off and remaining relatively flat until mid-2024. This is consistent with Fed Chairman Jerome Powell's remarks following the most recent interest rate hike. Powell predicted that the interest rate cycle would last longer than expected, peaking at just under 5% at the end of 2023. This is also consistent with much of the advice given by public companies. Layoffs in the technology sector in particular are becoming increasingly common, but this is expected, all to improve their bottom line and position them well for the future growth. Though we can anticipate a similar trend in the housing market, because rates will remain volatile, house prices will face downward pressure as mortgages become more expensive over time. And as we near the end of the tightening cycle, home buyers are also likely to postpone their purchases, slowing the market even further. Year number 5. Looking ahead 5 years is difficult. It's far enough away that a million different unexpected events could take place, derailing our expectations about how the economy and the housing market will perform. Having said that, there are always experts willing to make long-term predictions. Overall, the long-term outlook is fortunately favorable. Lawrence Yun, chief economist for the National Association of Realtors, believes total price growth in the United States will range between 15 and 25% over the next 5 years. As previously stated, this is likely to take the form of a drop in the coming year and leveling out into 2024, and then a period of relatively strong growth. Well, I kinda agree. I believe that the U.S. real estate market will provide an average annual return in the mid to low single digits over the next 5 years. Besides, in the long run, we are aware that the real estate consistently offers returns that are higher than the rate of inflation. We all know it's never a straight line, but the longer the time frame, the more certain we can be about the general direction of travel, which in real estate has historically been fine. What I mean by fine is it'll eventually go up no matter what it goes through. That's some good news right there. And overall, growth over the next 5 to 10 years is likely to remain strong. The main issue affecting housing affordability will not be changes in property values, but rather the increased cost of mortgages required to purchase them. How potential homebuyers likely can get ready. In this housing market, it's likely to cool a little bit, but mortgages will become more expensive at the same time. So this leaves potential home buyers in a tight spot. And those who have been diligently saving for a down payment may now find that the property they had in mind is unfortunately out of reach. As for mortgages, has just added $500 plus to their bottom line. It is possible that timelines will need to be raised and the down payment amount will need to be increased. In reality, there are only 2 options for improving this situation: save more money or improve your investment returns. It goes without saying that if you're thinking about investing your funds in for a down payment, you need to have a good long enough time frame. And if you're planning on purchasing within the next 12 months, cash is king. Investing may be worth considering if you have 3 to 5 years or more. Even so, you don't want to take any crazy risks. After all, it's for a house. Alright guys, thanks for watching my videos. If you have any questions, leave a comment below. Give me a thumbs up and I'll see you in the next video.